Welcome to episode 26 of the Tax Smart Daily, a daily video series for real estate investors to get tax smart. I'm Brandon Hall, and before we get started, I invite you to join our Facebook group and our Tax Smart newsletter. Links to both of those are in the description of this video. Additionally, if you have any questions or any comments, please drop me a comment in the comment section of this YouTube video. I really enjoy engaging with the community. You guys keep bringing me back to the table. So thank you to all of those folks who dropped me a line. And lastly, please subscribe to this channel. I don't want you to miss any future videos that we drop. We have the daily video, we have the podcast, live Q&As, webinars, that type of thing. Today's topic is how can flippers avoid or reduce tax on the income that they receive? So yesterday we talked about investors versus dealers, and you learned that flippers are dealers in most cases, the vast majority of cases. If you're flipping homes, you're a real estate dealer. And what that means is that your flips are treated like inventory, not technically inventory, but like inventory, in the sense that you capitalize the costs that you incur to buy and renovate the home, and you back those costs out as cost of goods sold whenever you sell the flip. So if I buy a property for $100,000, I put $50,000 into it, and then I sell it for $200,000. In the year that I sell it for $200,000, that's when I write off the $150,000 of the purchase costs and the rehab costs. And so in that year that I sell it for $200,000, I'm going to recognize a $50,000 gain, and that gain is actually going to be considered ordinary income to me because I'm a real estate dealer, and that ordinary income is taxed at my marginal tax rates, not my capital gain tax rates, my marginal tax rates. And it's subject to self-employment tax. So pretty big tax impact or pretty negative tax impact for flipping property versus buying and holding. And that's true even if I flip the property and then I hold it for a year or two, I'm probably still going to be subject to that ordinary tax, that marginal tax plus the self-employment tax, not long-term capital gain tax, even though I held it for 2 years, because intent is a big piece of this. So if you were ever audited and you're claiming long-term capital gains on your flips that you hold for more than 1 year, the big question is going to be, what was the intent of this flip? Did you really intend to hold it, or was it always the intent that you were going to rehab it and flip it? And of course, there's a bunch of other factors that kind of go into that. It is a facts and circumstances based test or look. So there's a lot more that goes on there, but just keep that in the back of your mind. Now, the question is, how do I avoid tax? What are some methods to avoid tax if I'm flipping? And there's three key tax avoidance strategies for flippers that come to mind. The first is to run your business through an S corporation. Now, this is state by state. Some states don't recognize S corporations. If you're in New York City, or if you're in Tennessee, for example, they recognize, well, New York City doesn't recognize S corporations, but both of those cities and states will add additional taxes at the state level that negate the benefits of running your flipping business through an S corporation. The purpose of running a flipping business through your S corporation is to reduce your exposure to self-employment taxes. So on every dollar that you earn as a flipper, you pay a 15.3% self-employment tax. But if you run it through an S corporation, you only pay that 15.3% self-employment tax on the reasonable compensation that you pay yourself. So if I net $100,000 and I'm running that as a sole proprietor through a single member LLC or on my Schedule C, that $100,000, I'm going to pay a $15,300 self-employment tax. There's a deduction for your half, which I'm not going to get into. So just to keep it simple, $15,300 on my $100,000 in earnings. That's my self-employment tax. Then I pay my marginal tax. Then I pay state taxes. So I'm going to pay a lot of tax. If instead I route that $100,000 of net flipping profit through an S corporation, it could be an LLC taxed as an S corporation, or it could be a C corporation taxed as an S corporation. If I route that $100,000 through an S corporation, then I have to pay myself a reasonable salary from that S corporation. Maybe I pay myself $60,000 out of the $100,000 of net profit. And what that means is the remaining $40,000 of net profit will be paid to me as a cash dividend. I don't pay 15.3% on the cash dividend. I only pay the 15.3% on the $60,000 of W-2 wages that I've paid myself. So in that example, I save probably around what is that, 6,000 or so? So it's maybe around $6,000 in self-employment taxes. I should have calculated that before I just threw that out there, but I'm sure somebody in the comments is going to correct me. But $40,000 times 15.3%, that's my savings if in this example, when I run it through an S corporation. So when you run your business through an S corporation, you have to pay yourself a reasonable wage. And you only pay the 15.3% tax on the reasonable wage. So you get to avoid a portion of that self-employment tax. It helps you mitigate your exposure to it. Now, reasonable wages, don't just go and make stuff up. So I just used 60%. Don't go and use 60% on your tax returns because you heard about it on some YouTube channel. Don't do that. You have to get an actual analysis performed by a CPA, by a tax advisor. I highly recommend that you do that. It's not technically a requirement, but I highly recommend that you do that because we've seen a lot of people use like a 30% ratio. And when you ask them, how did you come up with this 30% ratio? They go, I don't know. Or my CPA just came up with it. And then you go ask the CPA and the CPA just says, yeah, this is what we normally do. But the problem is that that's not going to actually hold up in any sort of audit. And there's a few tax court cases out there that you can go and look at to substantiate that statement that I just made. So you have to have a reasonable you have to pay yourself reasonable compensation, and there's a method to the madness to figure out what is reasonable compensation. And frankly, if you're self-employed, you're a sole owner, and you're not relying on a whole bunch of other people to help generate the profits, then on my $100,000 example, I'm probably going to pay myself $90,000 in W-2 salary versus something lower than that because I'm the one that's driving all the profit, right? The profit's there because of me. Perhaps I have a couple of contractors that I'm using. So running through an S corporation, that's one way to avoid or reduce exposure to taxes. Another way to do it is to set up a solo 401k or a self-directed IRA, but I like solo 401ks because you can max out the 57,000 roughly contribution faster with a solo 401k than you can in a self-directed IRA. The reason for that is on the solo 401k side, I can make my employee contribution of $19,500, and that's dollar for dollar. So if I earn $19,500 or about $20,000 in self-employment income, then I can put $19,500 into my solo 401k. Subsequently, or if I pay myself $19,500 in W-2 income, I can put the entire $19,500 into the solo 401k, and that's that kind of that S corporation scenario that we were just sort of talking about. So solo 401k, I can put the employee $19,500 in, and then I also get the employer match and the profit sharing. The employer profit sharing is typically either going to be a 20%. Up to a 20% or up to a 25% profit sharing. So 20% if you're running through a Schedule C, 25% if you're basing it off of your W-2 wage. Now, what the heck does that mean? All right, if I netted $100,000, then and I'm running it on a Schedule C, then I can put my $19,500 in plus $20,000, 20% of my net self-employment income. So I can put a total of $39,500 into my solo 401k. On the flip side, if I'm running it through an S corporation, I net $100,000, I pay myself $50,000. I could put $19,500 into my solo 401k from the employee side, and then also the employer match of 25% of $50,000. So if you're paying yourself a W-2 wage, you can put up to 25% of the W-2 wage as the employer profit sharing. If you're not paying yourself a W-2 wage, you can only put up to 20% of the net self-employment income as the employer profit sharing. But you can always put that $19,500 employee contribution into the solo 401k. So really cool tax avoidance strategy. Self-directed IRAs, same sort of thing, same ratios. You just don't have the employee contribution of $19,500. So you have to earn more money to max it out at that $57,000 maximum. The third and final way that at least kind of pops into my mind as to how do you avoid or reduce your income so that you can avoid some taxes, is to think about your expenditures and the timing of your expenditures. So if you've been flipping for a while, you probably know about Section 179 that allows you to write off like vehicles and things like that. And I'm not going to get into the merits of that right now. There are pros and cons to writing off your vehicle, and there's a lot of things that you have to do if you're going to go down that route. But my point is more about, think about what you need towards the end of every year for the next year. So as we get closer to the end of 2021, maybe in 2022, I expect to double or triple my flip business. Or maybe I can ask myself today, what would it take me to double or triple my flipping business, the number of deals that I'm running at any one time, my team. But the point is that if you can plan that out, you can go ahead and buy equipment today that you need for next year. And buying the equipment today will reduce your taxable income this year and thus reduce your tax this year. So that third option to reduce tax exposure, an easy one, is just to think about the timing of your expenditures and make sure that you time those expenditures appropriately based on whatever net income you have coming in on a year-to-year basis. Sometimes it might make sense to hold off until next year. Other times it might make sense to go ahead and buy this year. Maybe you're doing a whole lot of volume in 2021 and you don't expect a whole lot in 2022, or you're going to dial it back in 2022. Well, you might want to buy whatever you can this year to pay in advance for 2022 to reduce your 2021 net income. It's always going to have a business purpose though, so make sure that you're not just spending money on random things that are not actually going to help you grow your business or run your business. So that's it for today's episode of the Tax Smart Daily. Thanks so much for watching. Check out the description of this video. We've got a whole bunch of links to our social media and various communities. We'd love to have you a part of them. If you have any questions or comments, please drop them below. I'd love to engage with you. And thank you so much for the folks that do.